Hi there. So this is for grade 9s and this is to help with preparation for July exams or just any exam or test in general. This specific video is going to be talking about accounting equation and specifically looking at those journals transactions. So let's jump right into it. They say to us in this exercise that we need to show the effect of transactions on the accounting equation. So basically analyzing transactions according to the accounting equation. They also then tell us that the business uses a markup of 50% on cost. So very first thing that I need you to take note in the sentence is that the business uses a 50% markup, meaning that when we need to calculate cost price, we're going to have to take a selling price that was given to us, and we have to say times 100 over 100 plus markup. So in this case, my formula to calculate cost price will be selling price times 100 over 150. Then if I want to calculate selling price, I'm basically swapping everything around and saying to calculate a selling price, I'm given a cost price. I take the cost price times 100 plus markup, which in this case is 150 over 100. So you can see I've basically swapped those two and I've swapped what's on the fraction. Okay, and there we go. So that's the formula I'll need to use. Remember, when we have any type of sales transaction or a return by data, that will require a cost price and a selling price for each transaction. Right, and those ones are also the ones that teachers love to ask because it really tests whether you understand the process. Okay, so when you're doing accounting equation, something that I would really advise you to go ahead and do is to basically go and draw not all T accounts, but in accounting, I mean, everything is pretty consistent. So if you understand it once, then it really helps you a lot going forward. So if you know how to deal with a certain problem or handle a certain question, you'll see that these T's that I'm drawing now will just really help you. The first one is bank. Now bank, if a T account has a debit and a credit side, left is always debit and right is always credit. Now, bank is an asset which always increase on the debit side and a decrease on a credit side. So a bank account should always look like that if it's got money in it. Then the other account that I would say is quite important to understand how it works is the one called debtors control. Remember, debit is always left. And debtors are actually also seen as an asset because they owe us money. Right. And then lastly, the third account I would recommend that you draw is trading stock, as these three accounts just help you to think through the transactions that you might expect to get. So let's go through them. And you'll see that just like I did with the CRJ, CPJ, DAJ, and DAJ in the journal activity, the first thing to always go ahead and do is to classify transactions according to the journal. So day one's transaction says the owner increased capital. So as soon as you see the word capital, that should tell you that this is CRJ. The second one says we issue an EFT to purchase inventory, that is CPJ because we're making an EFT. Then the third one says cash sales according to the cash register roll, that represents a CRJ transaction. Then day 4, or sorry, not day 4, but number 4 is credit sales, which is always going to be seen in the DJ. And then number 5 is a debtor returns goods, which will then go to the DAJ. What's also quite nice is if you've watched the general ledger activity video, there I explain posting rules of each of these journals, and you'll see if you know those posting rules, it just makes your life a lot easier, because in accounting things don't just change, it is quite consistent. So if you know how the CRJ is posted to the general ledger, then what I'm doing here should also look very familiar. But now let's go. Number 1, the owner increased her capital contribution by 300,000 Rand. So she actually put in 300,000 with a direct deposit into the bank account of the business. So therefore, the first column asks me which journal would this go to, CRJ. If it was a direct deposit into the bank account, we can use a bank statement for that. And this is usually where the part comes where people struggle to know which account is debit. So the abbreviation for debit is DR, and the abbreviation for credit is CR. So each transaction has a debit and a credit, and that's called the double entry principle. When I'm debiting one account, I'm crediting another with that same amount. So when we see it CRJ, it's important to understand that any CRJ or CPJ transaction is going to affect bank. If you think about it very carefully, the CRJ transactions is where we're receiving money. We take all the money we've received and we usually put it in bank. Because if I'm receiving money as the business, I want to make sure that money reflects in my bank account. So what we can say is when it's a CRJ transaction, bank is always going to be debit, because every time I receive money, my bank is going to increase. So what you'll do is you'll then write account debited as bank, and then you'll say, okay, but why did I receive money? Just like we did in the journals. Why did I receive this money? It was because of capital, and that is why the other account, if bank is debit, the other account has to be credit, and that's obviously looking at the transaction to read why did we receive money. All right, so there we go. There's the account debits and account credits, and it stems from the journal that this transaction would go to. That helps you to know that the bank in the CRJ will always be debit and the other accounts will be credit. Then when it comes to the accounting equation part over here says that assets are always going to be equal to your owner's equity plus your liabilities. So that's an equation, and it will always be like that. Again, it does not change. So then obviously again, all comes back to your grade 8 account classification. Do you know which accounts are assets, which accounts are owner's equity, and which accounts are liabilities? So bank is an asset. As soon as there's money in the account, bank is an asset. Capital we'll see as owner's equity. So then we say, well, we did receive this money, so my bank is going to increase with 300,000, and therefore my asset for bank is increasing. When it comes to owner's equity, this one is quite important because owner's equity is affected by 4 different things. The first 2 is those owner's accounts, the capital and the drawings. But then the owner also cares a lot about the income and the expense, because at the end of the day, with income and expense, we work out a profit or a loss. And that is why when we say that the business has more capital, we say that the equity of the business has increased. And same with income. So income and capital always increase owner's equity because the owner knows that their interest in the business becomes more when they put more money in and when the business earns income. Then for drawings and expenses, it will always decrease the owner's equity account or the owner's equity column, as that reduces the interest of the owner. And therefore, because we are working here with capital, we're going to say that capital always increase owner's equity. Now this equation is in balance because positive 300,000 is equal to positive 300,000. So I would not be able to put a minus there. That would mean that my equation is out of balance. So that is definitely just a way to check, did you do this correctly? Perfect, that's number 1. Number 2, issue an EFT number 150 to ABC traders to purchase inventory. So in this case, our journal is CPJ. The bank statement will also be the document because it's an EFT. And then if you think about this logically, when we had the CRJ, bank was debit. So CRJ and CPJ is really opposite. So that should already tell you that bank can't be on the same side. Another way of thinking about it is to go to the actual bank T and say, well, if I'm paying money every time, my bank will have less money in it. So all payments we make will essentially reduce how much money I have in bank. And therefore, every single time it's a CPJ transaction, my bank is going to be credit. And that's exactly what I'm going to do. So account credited is bank. And account debited, in this case, will be inventory or trading stock, as that is what we have bought. Now, if you look at this, inventory is an asset. Bank is also an asset, which means I'm only going to use my asset column, as I cannot put something in owner's equity and liabilities if there's no account debit or credit of that type. So what that means is we need to know that when I'm working with two assets, in this case, I'm paying money, so my money will become less, but the inventory I'm buying is becoming more. If I had no inventory and now I bought some, my inventory is increasing, but my money in the bank is decreasing with 5,900. So very important, once you see you working with two assets, you can almost know that that's going to be the case. A plus and a minus in your asset column. Right, so CPJ is always bank is credit, everything else is debit. Then the sales transaction. Cash sales according to the cash register roll was 9,600. There's basically two lines for number 3. It's because we've got a part A and a part B. You'll see part A is always using the selling price. Part B is using the cost. However, for this whole transaction, the source document is called cash register roll. Now, you'll see that we are consistent, that every time it's CRJ, my bank is going to increase. So my bank increases on the debit side, and therefore I'll say bank is debit. Now, if you think about it, the customer will always pay the selling price. And that's why my bank is increasing with the selling price. And the contra account, the account credited, is called sales. Just like in the journals when we wrote it there, we put the amount in bank, and we put an amount in sales that was the selling price. So you'll see I'm working with the selling price first, which is the amount that was given, 9,600. If it wasn't given, you'll anyways have to work it out using those formulas. Now, I'm saying that my bank is increasing because I received money, and income accounts increase owner's equity. And therefore, the amount that we are receiving for this cash sales, 9,600, goes into assets as a positive and into owner's equity as a positive. So as you can see, number 3A and number 1 looks very similar. The only difference is what did we credit. But now with part B, this is very important. For part B, we first would need to go and work out a cost price. To do that, I substitute my selling price in, and I then say times 100 over the 100 plus markup, which 150 in this case. Now, always remember your calculator is very important in accounting. You don't want to do these things off by heart or to try and do them without a calculator. So that tells me if I type that in, my cost price is equal to 6,400. That means that's the amount of stock that I've actually sold. And that's where this trading stock account comes in quite handy. If you think about stock, when we bought stock, we would have credited bank and debited stock. So here is what we actually did in the previous transaction. We debited stock or inventory, and we are crediting bank. But now in transaction number 3, we are selling the stock. So when I'm selling stock, it's always going to decrease my stock because I've got less stock. And the account we always fill the cost price in our journal is the cost of sales column. So therefore the entry will always be credit trading stock and debit cost of sales, because my trading stock is decreasing. So, sorry, let me just be consistent. Inventory is also a perfect way of referring to it. So my inventory that I sold is decreasing the amount of inventory I've got. And then I've got cost of sales that shows an expense that I had to incur to make this income. So the stock didn't just arrive for free. It actually costed me something to make this sales. And because we're working now with the cost price, I'm saying that my inventory is decreasing because I sold it, and expense accounts will always decrease owner's equity. And there we go. We've got the cash sales transaction filled in. Right, so my suggestion is usually to the people that I tutor that you actually go and study basically this whole block, what's debit, what's credit, and then even the signs, you'll see if you've practiced this a lot, that it's really always going to look like that. If it's cash sales, your whole transaction will look exactly like I've shown here. Right, and now that we've got that done, let's move on to number 4. Number 4 is a credit sales transaction, which is a DAJ transaction, and we will have a duplicate invoice. So an invoice is the document. Here we also have A and B with selling price and cost price. And you'll actually see it's going to look very similar to what we did there. The only main difference is the bank part. Obviously, if I'm selling on credit, I'm not actually receiving money. So bank won't be involved in this transaction. However, when a debtor buys on credit, we say they owe us more. So every time we've got sales going to a debtor, we say the debtor owe us more. So debtor's control will be debited. And the reason they owe us more is because of sales. So if you look very carefully, bank and sales, this time it's just debtors and sales because it's actually being sold to a debtor. The signs, however, look the same because debtors owe us more and our income increase our owner's equity. So there we go. For part B, we need the cost price. So the cost price calculation is a formula, and I simply say 8,300 times 100 over 150, and that gives me a cost price of 5533. There are there's a decimal, but I'm just going to round off. So therefore, part B is basically exactly the same as what we did there. Because if I'm selling on cash or for cash or on credit, the stock is still leaving my business. So whether it is in the CRJ or whether it's in the DAJ, when I sell stock, my stock becomes less. And that's why my cost of sales account gets debited, because it tells me what was the cost price of the stock we sold, and inventory just shows we have less stock now that's left over. Right, and therefore it's an expense and my asset is less, because if I'm selling inventory, I've got less inventory, and when I've got an expense, it decreases my owner's equity. So if you compare number 3 and number 4, the main difference is obviously the journal, the document, but other than that, everything is exactly the same, except where it's bank, we replace debtors when it is a credit sales transaction. Right, and like I say, this is really consistent. It will always look like that, so you can really go and test it out. Right, the last transaction I want to go through is goods returned by debtor. So here we again have a selling price and a cost price. When the debtor returns, we call that journal the DAJ, and it will be a duplicate credit note. Right, so then we go ahead and we say, well, when we sold to the debtor, they owed more. So if they return, they owe less. And the column we use in the DAJ for the selling price is called the debtor's allowance column. So what will happen is debtor's control will be credited and debtor's allowance will be debit. Debtor's allowance is seen as an expense, whereas debtor's control is always an asset. And you can think about this logically, because the debtor did return stuff, so the debtor actually owes less, 1,200, and an expense decreased my owner's equity. So as you can see, it's basically the inverse, the opposite of what we did there, we're doing here. So debtor's allowance is basically the opposite of sales. And then one last part is then part B. We need a cost price firstly, doing that same process of substitution into the formula. My cost price is 800. And the cost price, like I said, always refers to the stock. So if the stock was sold, we had less. But now when the stock is returned, we have more. And the way we entered it when we sold it, we will now enter it when it is returned. So my stock account will increase because I've now received stock back. So inventory increases, and the cost of sales expense actually decrease. So in this case, we've got more stock with a cost price of 800, and my cost of sales expense decrease. When the cost of sales expense increased, we said owner's equity decrease. But now technically what's happening is my expense is going down, which is really good for the owner, and that obviously will then give us a positive owner's equity, as if you have more expenses, yes, it does decrease owner's equity. But if you have less expense, it actually increases your owner's equity. And once again, like I said, I would say number 3, 4, and 5 are probably the most popular transactions. So make sure you almost know them off by heart so that there's no chance of you getting it wrong.